Global resilience has not yet been fully tested. And there are some worrying signs the test may come. Just look at the surging global demand for gold, spurred by valuation effects and net purchases, partly reflecting geopolitical factors.
Hello, everyone, and welcome to the Week Ahead on Nomura podcast. My name is Ruben Paracuelas, Chief Southeast Asia Economist at Nomura, and today is Friday, the 10th of October. Politics continues to take center stage with the shocking LDP election result in Japan and the resignation of the French Prime Minister after less than 4 weeks in office. The euro has weakened as a result, while dollar-yen has surged. And so has gold prices, breaking the 4,000 level, which IMF Managing Director Georgieva, as you heard from that clip, attributed to geopolitics and high uncertainty. Meanwhile, the government shutdown in the US has entered a second week with no clear resolution yet in sight. We discussed the economic and monetary policy implications with David Seif, our Chief Economist for Developed Markets, and he is joined by our guest speaker, Samira Fazili, who heads our public policy and government affairs team based in Washington, D.C., and will give her take on how and when the U.S. government shutdown could end. In Japan, Yuichiro Nozaki from our economics team in Tokyo outlines what's next on the political calendar, the main policy features of the so-called Sanaenomics, and the implications for the BOJ. Lastly, Andrei Shepenyak breaks down for us what to expect from the political saga in France, including prospects of a legislative election and how that resolves the impasse or not. So let's dive in. All right, let's kick off with the U.S. And as mentioned at the top of the podcast, we focus on the U.S. government shutdown, but do things a little differently. David is back with us to the podcast to give his perspective on the economic implications. And I'm very delighted that we are also joined for the first time by Samira, who is in Washington, D.C., to give her take on how this can politically be resolved, and more importantly, by when. So thank you both for being here.
Great to be here.
Thank you.
Yeah, so starting with David, normally we do the data calendar first, but we're not getting any releases, including the ones next week. So, but we've had a few Fed speakers. So, David, maybe could you walk us through your thoughts about the comments that have been made so far?
Yeah, it's been a very interesting week or so for Fed speak, and we anticipate another interesting week until the blackout period begins on October 18th. We really have seen since the September meeting dovish and more hawkish factions emerging, and they are not afraid to speak their mind. And it really harkens back to how the Fed had operated for many years. It seems a little old school, but of course, with old school, we only mean until about a year or so ago on the Fed. And I think it's a very healthy debate. We've had new Governor Myron speaking repeatedly about his far more dovish view about how R-star is lower than the Fed thinks, the rest of the Fed thinks it is. And we've had Governor Bowman joining him quite a bit on this. One interesting thing that we have not heard, though, is any comment by Governor Waller since the September meeting, at least with regards to monetary policy. And I think that really does leave a question. Is he as on board with this as Governors Myron and Bowman seem to be, with this dovishness? So we do now have two speeches planned by Waller on Tuesday and on Thursday next week. And we'll see if he opines on monetary policy at all. He declined to talk about it in his one speech so far, but I think that is certainly of interest. Now, on the other side of the coin, of course, we have some of the more hawkish members of the Fed who are implying that although they went along with the 25 basis point cut in September, they're not necessarily comfortable with two more cuts this year. So it is certainly our view that Chair Powell is on board with 2 more cuts this year. He'll be speaking quite soon before this podcast comes out, but after the recording. We don't expect him to break any new ground, though. And it seems as though, although he's not as dovish as Governors Myron or Bowman, or presumably Governor Waller as well, that he does still maintain the base case of 25 basis point cuts at both of the remaining 2025 Fed meetings.
Okay, great. Yeah, thanks for summarizing that. And I'll get back to you later on the view on the Fed. But turning to Samira, I saw from your note, I think a few days ago, which highlighted that if both sides are not moving to a resolution this week, the shutdown could last another week, maybe even longer. So from your perspective, what will it take politically for the two sides to come to an agreement?
I think for both sides to come to an agreement, I think they'll need to feel the political pressure. And right now, neither side is really feeling it. Democrats feel very emboldened, actually. I think Schumer said the longer this goes on, the better it is for us, or something to that effect. And, the longer this goes on, the more leverage Democrats have. Polling has shown most Americans blame Republicans and Trump for the shutdown. So right now, they're not really feeling political blowback. And I think on the opposite side, Republicans are really not feeling too much of it either. Maybe a little around the edges, but not enough to really come to the table and negotiate. I think an inflection point could be reached next week. On October 15th is when military members will miss their first paycheck. And so I think if Congress is willing to allow that to happen, then I do think that this could go on potentially to the end of the month into November. But I do think that'll be an inflection point. Right now, there's a few proposals out there. The White House has kind of floated Congress passing a standalone bill to pay military members. Republicans don't want to do that. But that'll be an inflection point where we'll see kind of where things go at that point. But, it'll really take, public opinion turning against one side in a very dramatic way. But right now, I just don't think either side feels that crunch right now. So I think this could go on. If again, and I said this last week, I'll say this again. I think if there's not a resolution early next week, I think we have another week to look at. And November 1st is when the Affordable Care Act premiums will go up, and people will get notices about that. And there's been some thinking that Democrats may want to wait until that point, so Republicans really feel political blowback for the increase in healthcare premiums. There's some discussion that maybe Senator Schumer wants to wait until October 18th when there's this big No Kings rally that will be happening. That's a Republican speculation. So I think there's different dates people are looking at, but I think overall this will be a long shutdown, and I would not be shocked if it went till the end of the month.
Okay, great. And David, I guess back to you. With all that uncertainty and potentially a relatively long shutdown, are you starting to worry about potential impact on near-term growth outlook in the U.S. Given all the uncertainty?
Yeah, it's a fair question, but I think the only appropriate answer to give is just no. We're not that worried about the impact of the shutdown on growth. Now, I think there's a lot of curiosity, a lot of worry by some investors about what the labor market data are going to look like, and that's separate from the shutdown. But sort of people were anxiously awaiting the jobs report that was supposed to come out October 3rd. That, of course, will be delayed for some time. And then the report that was supposed to come out in early November would have included, or will include when it does come out, the some impact from the Doge layoffs, which are the Doge buyouts, which took effect at the end of September, and therefore would have been in the October numbers released or scheduled to be released in early November. In addition, the number of people who are furloughed should lead to a 1 month, assuming the shutdown only goes on for 1 month, should lead to just a 1 month temporary uptick in the unemployment rate. So it could mean that report that was scheduled to come out in early November will look quite ugly when it does come out. But I don't think that will speak to a fundamental weakening in the U.S. economy or anything like that.
Yeah, I guess a quick follow-up, and again, taking into account what you said earlier about the Fed, are you still convinced that they will cut again in October despite flying blind potentially without the data?
Well, we think that actually the more that they are flying blind without the data, the more likely it is that they will cut exactly 25 bips, so not more, not less. And the reason is, what do they have to dissuade them from that? They put out there that was their effectively their base case. And without something to convince them otherwise, it's hard to see why they wouldn't do it. I would say that there are risks, arguably to both sides, to that December meeting, assuming the data have come out by then. It's our call that they will cut another 25 bips then, as the dot plot indicates. But assuming they have the BLS is caught up on the data by then, if the data are particularly hot or cold, it could lead them to deviate. But it's very hard to see them coming up with a justification for doing so in late October.
Okay, so the bar for not doing anything in October still sounds pretty high. And then again to Samira, and David, you can add on this as well. How high do you think is the threat of mass layoffs of federal workers? And do you see any major political consequences or even economic consequences from that, including potentially the midterms for next year?
So I think the risk of mass layoffs at this point is probably pretty low. Even the whole federal government layoff process takes some time. You can't tomorrow say you're fired and the person just leaves. There's a 30 to 60 day period where that involves firing someone at the federal government level. So I think that's a little bit, I think that was more of a threat. And I do think that you may see some announcements. I just think practically it's going to be difficult. And a lot of these agencies are already pretty short-staffed, and congressional Republicans have warned the White House against mass layoffs, fearing political blowback. So, I think you may see some kind of splashy announcements. I don't know if it'll actually lead to real layoffs at the end of the day, because I also think in a negotiation with Democrats, if you've laid off several thousand federal workers, I don't know if that's really going to be a good starting point for negotiations. And I do think congressional leadership at the Republican side understands that. In terms of the midterms, I could be wrong, but I feel like our news cycles are so volatile and so quick that I think by November 2026, this shutdown may be a distant memory. Who knows what'll happen between now and then. But I think the political blowback from this, I don't necessarily think it'll be felt in the midterms, unless we're just it's shutdown fight after shutdown fight. I don't think this singular shutdown fight is really going to have much of an impact in the midterms.
David, do you agree?
Great. I very much agree with Samira's sentiments, and I'll just say that we in research are also not terribly concerned about the prospect of mass layoffs and increased longer run unemployment as a result of that.
Okay, brilliant. And before we close, I just want to mention quickly here that next week on the 15th of October, we're actually holding our inaugural Nomura Research Forum in Washington, D.C. We've got top policymakers in the lineup, including Steve Myron. So should be an exciting one. And David has been very instrumental in putting the event together. So we're really looking forward to hear the takeaways from that forum. And yeah, watch out for that. So yeah, thanks again, David and Samira.
Thank you.
Thank you.
Okay, next we go to Japan, and I'm very delighted to be joined by Nozaki-san from our economics team in Tokyo. Obviously, a lot of things are happening, and even as we speak, we've heard some news about the coalition, and we're recording this in the afternoon of Friday in Asia. So thanks very much, Nozaki-san. First of all, how did this surprise come about in terms of the LDP election, which was won by Takaichi-san, who will potentially become Japan's first female prime minister?
The LDP presidential election began with a first ballot contested by 5 candidates, followed by a runoff between top 2. Voting rights belong to LDP Diet members and party supporters. In the pre-election polls showed that both Diet votes and party supporters' vote had favored Koizumi, the former prime minister's son. But in the actual first round. However, Takaichi won the party member vote by a landslide, and as a result, more Diet members shifted their support to her in the runoff. In addition, Aso, who served as financial ministers under the administration, moved many votes.
Yeah, that's interesting. Thanks for that. From a policy perspective, what will be Takaishi-san pushing under the so-called Sanainomics, which I think seems to be liked by equity markets given the rally this week, but also at the same time, the Japanese yen have sold off?
There are three key points. First, economic security is being positioned as the core of the growth strategy. The plan emphasizes large-scale investment in areas such as AI, semiconductors, and energy, which appears to be viewed favorably by the stock market. Second, an expansionary fiscal policy centered on tax cuts. ASO values fiscal discipline, so it's not expected that fiscal spending will expand recklessly, but super long-term interest rates rose rapidly. Third, she believes that the government should determine the direction of monetary policy. This raises the view that the BOJ will find it harder to move towards interest rate hike. Falling expectations for rate hikes, combined with worsening fiscal concerns, have led to a sharp depreciation of the yen.
Okay, we'll come back to that point on the BOJ, but in terms of the political calendar, what will be markets watching closely in the next few weeks or months?
Well, Takaichi is now leader of the LDP, but Ishiba remains prime minister. The Diet will need to hold a vote to designate the next PM in an extraordinary session. The date is being adjusted for October 21st, but as I will explain next, negotiations over the coalition partners are proving difficult, so the schedule is highly fluid. There are two steps to the coalition talks. The first is talks with the current partner, Komeito. The two parties, LDP and Komeito, have governed in coalition for a quarter century, but after the leaders' meeting on the 10th, today, Komeito notified that it would leave the coalition. The move is thought to reflect concerns about Takaichi's hawkish stance of foreign policy, her handling of political funding issues, and a distrust regarding the expansion of the coalition. There remains a possibility that talks towards reforming the coalition will be held in the future, but the talk between the two parties failed once. The second is expanding the coalition to include the DPP. The DPP's call for income tax cuts and gasoline tax reduction are highly compatible with Takaichi's policies. She has sought contract, but the labor unions that form the DPP's support base are clearly opposed to joining the coalition, so there is still some distance. The LDP does not hold a majority of seats, but the opposition parties are not united. So the main scenario that Takaichi will be nominated as next prime minister can likely be maintained. But the difficulty and uncertainty for government administration increased. With no coalition in sight, it is extremely unclear how the LDP will respond. Reporting on cabinet personnel is likely ahead of the October 21st Diet session. Attention will focus on who becomes financial ministers, which will be a barometer of Takaichi's fiscal expansion stance.
Okay, so it looks like still a very fluid situation, and a lot of things to watch in the coming days. And finally, Nozaki-san, any impact on monetary policy and the BOJ's path of future rate hikes?
Takaichi has expressed the view that the 2% inflation target should be achieved not by cost push factors but demand pull forces, accompanied by wage increases, a stance that is not inconsistent with Governor Ueda's remark. The next BOJ's meeting is scheduled for October 30. Given the timing immediately after the government takes office, the probability of October rate hike is low. Because Takaichi places priority on measures to contain high inflation, further yen weakness would be undesirable for the new government. From this point, the rate hike by the BOJ will be admitted by the new government to some extent. Nomura currently forecasts a rate hike in January next year, but depending on financial markets developments, a hike could be brought for December meeting.
Okay, got it. So a risk of the hike being front-loaded a little bit. Yeah, let's leave it there. Thanks very much, Nozaki-san.
Thank you.
For the rest of Asia, just wanted to mention some quick highlights in the week ahead. First of all, we have Singapore's MAS decision on deck, and our FX strategy team expects no change in FX policy, which is likely currently deemed appropriate and mildly accommodative. We also expect the Q3 advanced GDP estimate to show a slowdown to 1.8 from 4.4. Led by weakness in manufacturing output, partly as a result of the US tariffs beginning to bite. In China, we still see export growth to be relatively modest, around 4.6 in September from 4.4% the previous month, with weak sequential momentum due to the US tariffs again and slowing external demand. In terms of CPI inflation, which is also out next week, we should also see a negative print in China at minus 0.2% year on year from minus 0.4%, while PPI deflation should also ease, but largely due to base effects and broad-based stabilization in raw materials prices. And then finally, in India, we also expect CPI inflation to moderate to 1.3 from 2.1 due to deeper food deflation, while core inflation also edges up slightly to 4.2. The impact of broad-based cuts in GST rates announced late September is unlikely to be reflected yet. Now let's swing over to London, and I'm joined by Andre. Thanks very much for coming back to the podcast with plenty of things happening in Europe.
Thanks for having me, Ewan.
Yeah, first question, Andre. Obviously, the political turmoil in France is center of market attention. What is the latest on that, and where do you see things going from here in the coming days or weeks?
Gosh, France really is the gift that keeps on giving to some extent. Essentially, this past Monday, Le Cornu, the most recent Prime Minister of France, he resigned, but then Macron, the president, decided to give him 48 hours to try and find sort of last-ditch consensus between the various parties in the Assemblée. Now what we have is that Le Cornu believes there could be some sort of consensus building approach that could be found. And so Macron has until Friday evening essentially to find a new prime minister or announce a new prime minister. However, when it comes to the budget, actually, Le Cornu has submitted already a draft budget to the Assemblée Nationale, and it's now the onus is on the parliamentarians themselves to find a consensus and to actually vote through a budget rather than the prime minister himself being the one to sort of find the consensus and draft a budget which would garner support in parliament. So a bit of a different approach, but the hope or the intent at least is to shift the onus of responsibility away from the prime minister and more onto the parliamentarians in the hope that actually they can come to a consensus amongst themselves.
Yeah, and then speaking of Parliament, Andre, I guess just thinking about how this impasse could be resolved, how likely is a legislative election being called?
So the risk really is if the Assemblée Nationale cannot themselves agree on a budget and cannot find some sort of consensus to pass a budget by year end, then you will see Macron likely call new snap legislative elections. The issue is, though, opinion polling has been so similar to what we've seen since the election that was held last year, June, July. And so from that perspective, I wouldn't really think the makeup composition of any new Assemblée Nationale would be anything different from what we currently have. So very fragmented and a struggle to work with in that sense. So the best hopes in reality is that actually we do see the current parliamentarians get some sort of agreement amongst themselves. Just to sort of give context, the reason why the Bayreuth government and also Le Cornu's government both failed is they tried to achieve a very significant fiscal consolidation. We're talking reducing the deficit by approximately 1 full percentage point of GDP. That's clearly too much. We think something that's so bringing the deficit down to 4.6, 4.7 from 5.5, give or take. We think that's far too much. We think in reality, a fiscal consolidation, but one which still has a 5 handle, is more likely to pass through Parliament than anything else.
Okay, got it. That is interesting. And in that context, do you see any potential spillovers for the rest of Europe or contagion effects in financial markets across the region?
Look, already we've seen now the 10-year yield on the OATs trading above that of the 10-year on BTPs, which hasn't happened for such a long time in reality. And this is really, to some extent, owing to political risk. That said, we do believe there are macro fundamentals which do justify this. So if thinking about the debt accumulation equation, the R minus G dynamics, as well as the fact that France and Italy's primary balances are very different. But more generally speaking, you do have a lot of real money clients in France who do have a lot of cash which has to be deployed by year end. Now, if you still have a material amount of political uncertainty in France, the real question is, do they go for OATs by year end, or do they do what they did last year and go for EU bonds, Spanish bonds, etc.? So just as an example now, the Spanish bond, 10-year bond versus 10-year Bund is at about 54 basis points, and that's sort of been declining over the course of this year. The question is, could we see that below 50 by year end, owing to the fact that you might have these domestic real money clients going for non-French bonds to deploy their cash due to the fact that you still have that elevated political uncertainty?
Yeah, great. And lastly, any key data in the calendar next week that you're watching closely, Andre?
The data calendar is fairly light, but there are two things I'll just highlight quickly. One is the German ZAW. Here we are expecting to see an improvement in German investor sentiment, broadly in line with what we saw in the Centix survey. Secondly, in the UK at least, you have the labour market report for the month of September. There are lots of data points within that report to pay attention to, but in some senses, the most important for the Bank of England meeting on the 6th of November will be wages. And here we're expecting a 0.3% month-on-month for private sector regular pay growth, broadly a similar pace to recent months, though we acknowledge there could be some upside risks to this.
Okay, excellent. Thanks very much, Andre.
Thanks, Ewan.
That's it for now, and thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.